Welcome back, students and scholars. In this final ASC 230 episode, we are going to revise the full statement of cash flows topic, connect it with IAS 7 under IFRS, introduce the SAP statutory accounting bridge, and then link ASC 230 to future US GAAP topics. This is the closing map for the whole ASC 230 series. We are not trying to relearn every detail from scratch. We are locking the core logic so that when cash flow classification appears again in debt, equity, revenue, leases, hedging, foreign currency, or acquisitions, your brain says, I have seen this road before. That is the goal of a strong revision lesson. Not more confusion, but cleaner memory. Here is a learning path. First, we revise the ASC 230 core logic, cash focus, classification rules, method distinctions, and disclosure traps. Second, we compare ASC 230 with IAS 7, focusing only on high-value similarities and differences. Third, we introduce the SAP bridge through SSAP number 69, mainly for statutory insurance reporting. Fourth, we review exam traps where students often lose marks. Fifth, we connect ASC 230 with future ASC topics so you can carry this logic forward. This is not just a wrap-up slide. Think of it as a final airport checkpoint before the topic takes off into the rest of the US GAAP course. Let us start with the core memory. ASC 230 begins with cash movement. Inside the cash lens, we have cash receipts, cash payments, cash equivalents, and restricted cash totals included in beginning and ending cash balances. Outside the cash lens, we have accrual revenue, accrual expenses, and unrealized fair value movements. Those items may affect net income, working capital adjustments, or disclosures, but they are not cash flows by themselves. This is the first and most important filter. If cash did not move, do not force the item into the statement body. Cash flow reporting is not asking, was the transaction important? It is asking, did cash actually move? Different question, different answer. Now revise the three activity buckets. Operating activities include income-linked cash flows such as receipts from customers, payments to suppliers and employees, interest paid, and taxes paid. Investing activities include asset acquisitions and disposals, loans made and collected, and purchases and sales of investments. Financing activities include transactions with owners and creditors such as debt proceeds, debt repayments, share issuances, dividends paid, and treasury stock activity. The key rule is that every cash flow must go into exactly one bucket. No cash flow should be left homeless. ASC 230 is strict but fair. If cash moved, classify it. If no cash moved, disclose it separately where required. Now revise direct versus indirect method. The direct method lists operating cash receipts and payments, such as cash collected from customers and cash paid to suppliers or employees. The indirect method starts with net income and adjusts for non-cash items, working capital changes, and reclassified gains or losses. Both methods should arrive at the same net cash from operating activities or CFO. The method changes the route, not the destination. In practice, the indirect method is more common under US GAAP, while the direct method is encouraged because it is more transparent. Think of direct method as showing the cash receipts and payments camera footage. Indirect method is the detective report that reconstructs the same cash story from net income. Working capital rules explain the timing difference between accrual income and operating cash flow under the indirect method. If a current asset increases, deduct it from net income because cash is tied up. If a current asset decreases, add it because cash has been collected or released. If a current liability increases, add it because an expense has been recognized but not yet paid. If a current liability decreases, deduct it because cash has been paid for an earlier obligation. These four rules look small, but they are powerful. They appear again and again in cash flow questions. Increases in assets and decreases in liabilities generally use cash. That sentence alone can save many exam marks. Now remember the non-cash item rule. The statement body is for cash movements only. Significant non-cash investing and financing activities such as debt to equity conversions assets acquired through lease obligations, and similar exchanges are disclosed separately in a schedule or in the notes. If a transaction has both cash and non-cash components, only the cash portion enters the statement body. The non-cash portion goes to supplemental disclosure. This is one of the most practical rules in the entire topic. Non-cash items are not ignored, but they are not allowed to pretend they are cash. In a professional review, that distinction is not a small detail. It can decide whether the statement reconciles or fails. Now let us bridge ASC 230 with IAS 7. The foundation is familiar. Both ASC 230 and IAS 7 classify cash flows into operating, investing, and financing activities. Both permit the direct or indirect method for the operating section. Both require significant non-cash investing and financing transactions to be disclosed separately outside the statement body. So the overall cash flow architecture is similar. The differences arise mainly in policy choices and specific classifications. That is helpful for students. You do not need to rebuild the whole cash flow concept when moving from US GAAP to IFRS. You mainly need to identify where IAS 7 gives flexibility and where US GAAP is more prescriptive. One important difference is bank overdrafts. Under IAS 7, some bank overdrafts repayable on demand may be included as a component of cash and cash equivalents if they are integral to the entity's cash management and the balance frequently fluctuates between positive and overdrawn positions. Under US GAAP, bank overdrafts are generally classified as liabilities, and changes in those balances are generally reported as financing activities in the statement of cash flows. This affects both the cash balance and the financing section. So do not assume an overdraft is treated the same under both frameworks. Same bank account, different accounting lens. That is why comparison work exists. Standards enjoy keeping us humble. Interest and dividends are one of the highest yield comparison areas. Under IAS 7, there is more policy choice. Interest paid may be operating or financing. Interest received may be operating or investing. Dividends paid may be operating or financing. Dividends received may be operating or investing. The entity must apply the policy consistently and disclose it appropriately. Under US GAAP ASC 230, the treatment is more prescriptive. Interest paid is operating, interest received is operating, dividends paid are financing, and dividends received are operating for typical business entities. So the memory line is simple. IAS 7 gives more classification flexibility. US GAAP gives more fixed classification rules. Another difference is the indirect method starting point. Under US GAAP, the reconciliation begins with net income. That is the required bottom line measure from the income statement. Under IAS 7, the standard refers to profit or loss, and practice may vary by entity and jurisdiction, with some regimes using measures such as profit before tax. The broader concept is similar. Start with a performance measure and adjust for non-cash items and timing differences to reach operating cash flow. But the specific starting point is not always identical across frameworks. In exams and professional work, this is where wording matters. If the question says US GAAP, start with net income. Do not freestyle the starting point like a jazz musician with a cash flow statement. Now let us revise the predominant source or use principle. Under US GAAP, when a single cash receipt or payment has identifiable components that belong in different activity categories, the components are classified separately if practicable. If separate identification is not practicable, the entire cash flow is classified based on the predominant source or use of the cash flow. This fallback principle is especially useful for mixed or complex transactions. The discipline is to first ask whether the components can be separated. If yes, separate them. If no, identify the main economic purpose. This is not a guessing rule. It is a structured judgment rule, and ASC 230 expects that judgment to be applied consistently. Now let us bridge to SAP, meaning Statutory Accounting Principles. Through SSAP number 69, This statutory model is especially relevant for insurance entities reporting under the National Association of Insurance Commissioners framework. The statutory cash flow statement has its own lens because statutory accounting is focused on solvency, policyholder protection, and regulatory reporting, not simply GAAP income measurement. One key difference is that SSAP number 69 uses a direct method focus for operating cash flows. Another difference is the broader statutory cash definition, which includes cash, cash equivalents, and short-term investments. So when moving from ASC 230 to SAP, do not assume the same reporting lens. Statutory accounting is not just GAAP with a different jacket, it has its own purpose. The SAP disclosure bridge is also important. SSAP number 69 uses an activity structure with operating, investing, and financing categories, but with an insurance reporting orientation. Operating activities may include core insurance operations such as premiums received and claims paid. Investing activities include investment purchases, sales, and capital asset transactions. Financing activities include debt issuance, repayment, and owner equity transactions. Non-cash transactions still matter. If a transaction affects recognized assets or liabilities but does not result in cash receipts or payments, the cash and non-cash aspects must be clearly separated. This is similar in spirit to ASC 230, cash in the statement body, non-cash in supplemental disclosure. Let us log the final exam traps. First, interest versus principal. Interest paid is operating, principal repayment is financing. Second, gain versus proceeds. The full sale proceeds go to investing activities, while the gain or loss is removed in the indirect method reconciliation. Third, cash versus non-cash. Non-cash investing and financing activities never enter the statement body but must be disclosed separately. Fourth, gross versus net. Most cash flows are reported gross, and net reporting is only allowed in narrow circumstances. Fifth, cash flow per share. ASC 230 prohibits presenting cash flow per share in the financial statements. These are the traps that look small until they cost marks. Cash flow errors rarely arrive with fireworks. They arrive quietly in classifications. Now think professionally. ASC 230 is not a standalone topic that disappears after this series. Cash flow classification appears across many transaction cycles. Debt requires borrowing and repayment classification. Leases require right-of-use asset and lease liability cash flow analysis. Revenue creates contract asset and liability timing effects. Acquisitions involve cash paid, acquired cash, and contingent consideration rules. Hedges require derivative settlement classification. Foreign currency introduces translation and exchange rate effects. In practice, the statement of cash flows is where many transaction decisions finally reveal their reporting impact. It is like the cash version of a truth serum. Eventually, every transaction asks, did cash move and where should I go? Here are related ASC connections you should remember. ASC 310 links through receivables and loan collections. ASC 330 connects through inventory and working capital adjustments. ASC 470 connects through debt proceeds, repayments, and issuance cost treatment. ASC 505 connects through equity issuances, buybacks, and dividends. ASC 606 connects through contract assets and liabilities. ASC 805 connects through business combinations and acquisition date cash effects. ASC 815 connects through derivatives and hedging settlements. ASC 830 connects through foreign currency effects. ASC 842 connects through lease payments. ASC 860 connects through transfers and servicing. ASC 230 travels with all of them. Let us finish the ASC 230 series with the final takeaways. Start with cash. ASC 230 measures actual cash movement, not accrual income. Classify by activity: operating, investing, or financing. Separate non-cash items. Disclose significant non-cash investing and financing activities clearly outside the statement body. Compare frameworks carefully. IAS 7 and SSAP number 69 share the broad structure but differ in policy choices, method requirements, cash definitions, and reporting objectives. Apply the logic across future topics because this will not be the last time cash flow classification appears. If this ASC 230 series helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment and support the channel so we can keep building serious free education. In the next ASC topic, we will carry this same discipline forward and keep connecting US GAAP standards in a practical exam-ready way.